Hello everyone, Charles here, and in this presentation I'm going to cover an introduction to the harmonic pattern trading course. Before getting started, we must start with a disclaimer. Please feel free to pause the video and read through the entire disclaimer, but when trading any financial asset, there's a possibility you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose through this manner of trading. Trading involves a real risk of loss, and past performance does not ensure future results. So let's get started. Recognizing patterns. In order to be an expert at recognizing chart patterns, traders must resort to a great deal of practice and repeated exposure. It is only when a trader is able to recognize patterns that one is able to react according to altering market conditions. In the world of trading, the patterns on the chart are categorized as reversal and continuous patterns. These chart patterns can further be categorized as complex and simple. With adequate knowledge about these chart patterns and properties, traders are able to react and take an accurate trading decision. Trend and consolidation. The prices in the market reflect trend, consolidation, as well as retrend patterns. It is during the transitional phase that they witness trading ranges in addition to fluctuations in price. This range defines pricing patterns that are easy to identify. The consolidation phases favor the prevailing trends on certain occasions before forming into a trend and later continue to move in their specific direction. In the example to the right, we have an example of consolidation following a downtrend. So here, price continued down, creating lower lows and lower highs, okay? And then it reached a point where it fluctuated within a specific high and low set, okay? So once price breaks out of that, okay, to the upside or to the downside, then we'll see either, if it breaks to the downside, a trend continuation, or if it breaks to the upside, then we would see an example of a trend reversal. Why are chart patterns formed? Such patterns are referred to as the continuation patterns. Flags and cups handle in symmetric triangle. Certain phases, on the other hand, cause the previous trend to reverse as well as continue to move in the reversal direction. For instance, double bottoms, broadening patterns, and head and shoulders patterns. In the example to the right, you see a head and shoulder pattern example. Here we have shoulder, we have our head, and we have our shoulder. And here is the neckline. Okay. H.M. Gartley. Founded by H.M. Gartley in the year 1932, the harmonics patterns, as well as concepts of trading, were later improved by Larry Pesavento, and I probably said that incorrect, using the concept of Fibonacci ratios. The main concept behind the harmonics patterns is the movement in time or price that adheres to the Fibonacci ratios and their market symmetry. Trading harmonic patterns. The main reason for using the Fibonacci ratios is to determine the major turning points, extensions, retracements, swing low and swing high points. The projections and retracements derived after using such swing points provides traders with main pricing levels for your stops and targets. Why trade harmonics? Harmonic patterns offer trusted price entries, targets, and stops. They can be easily combined with many other oscillators or indicators to take accurate trading decisions. Benefits of harmonic patterns. They help traders in predicting their stops as well as movement of price and future. They are repetitive and frequent in nature. They work really well with market symmetry and context and help traders to take well-calculated moves. They work with all types of instruments available in the market in addition to different time frames. They allow traders to use other theories such as the RSI, CCI, MACD, DeMark, and other indicators. They provide attractive risk-to-reward ratio. They are independent of news and feature appropriate price patterns and structures. They define invalidation level for every pattern clearly. They fit the law of trading, buying when prices are low and selling when they are high. They enable traders to forecast trend reversals. They are highly advanced technical method of trading that can be automated with the help of free indicators or paid indicators. They allow traders to combine pricing patterns with the Fibonacci ratios. And they combine price patterns with Fibonacci ratios and numbers. Kind of repeated that one. Sorry about that. Disadvantages. They're highly complex and technical in nature, which makes it difficult for some traders to understand as well as perfect them. It's difficult to correctly identify and automate or code the harmonic patterns. The conflict in the Fibonacci projections and retracements make the task of identifying reversal and projection difficult. These patterns become highly complex when the opposing chart patterns are formed as a result of the same swing or other time frames or swings. The risk-to-reward ratio from lower ranked and unsymmetric patterns is low. These patterns are commonly seen in the range markets because of the manner of trading in which they are constructed. This causes the traders to lose opportunities in the markets that are trending. In my next presentation, we'll be covering the different harmonic patterns and begin to break everything down to its simplest form. That's it, and I look forward to seeing you soon.